Long-short strategies have emerged as an important investment category in portfolio diversification, particularly for HNIs and NRIs. These strategies allow investors to capitalize on both rising and falling market scenarios by taking long positions in undervalued stocks and shorting overvalued ones. This approach not only enhances returns but also serves as an effective risk mitigation tool in volatile markets. For large investors, long short AIFs are especially valuable as they provide an opportunity to access sophisticated investment techniques, balancing wealth preservation with growth. In a world where traditional equity investing alone may no longer suffice to meet risk adjusted return expectations, long short strategies offer a pathway to sustainable and superior outcomes. This panel features industry experts who will share their deep understanding of crafting and managing such strategies. And we have with us Mr. Kalpesh Jain, fund manager at Tata Asset Management with over 17 years of experience. Mr. Jain has honed his experience across fixed income trading, derivatives research, and hedge fund management. And Mr. Kalpesh's ability to navigate complex market conditions and generate low volatile risk adjusted returns makes him a standout in the alternative investment space. Before Tata, he held key roles at Julius Baer India Limited, Ambit Capital, and Edelweiss Financial Services, further enriching his knowledge of innovative strategies. We have with us Mr. Puneet Sharma, fund manager and CEO of Whitespace Alpha, and I am Lucknow alumnus. Mr. Puneet Sharma is a leader in designing advanced investment strategies with a focus on derivatives and cash markets. At Whitespace Alpha, he emphasizes creating high risk adjusted returns while incorporating robust risk management practices. His previous experiences as associate director at PwC India and his early career at SAIL bring a unique blend of financial acumen and strategic vision to his current role. We also have with us Mr. Vineet Jain, CIO and founder of Volvin Limited. And Mr. Vineet introduced India's first AIF centered on a covered call strategy, revolutionizing how conservative investors perceive risk and return. With over 30 years of equity market experience, Mr. Vineet has weathered numerous market cycles, including the Harshad Mehta era, the dot-com bust, and the 2008 financial crisis. His entrepreneurial spirit and innovative mindset have reshaped the alternative investment landscape. A graduate of MDI Gurgaon, Mr. Vineet's groundbreaking initiatives, such as India's first All India B School stock market game, underline his ability to think ahead of the curve. And this enlightening session will be moderated by Mr. Bhautik Ambani, who is the Chief Executive Officer of Alphagrip Investment Management. Mr. Ambani is responsible for driving business growth, strengthening and expanding the firm's domestic presence, and enhancing customer experience. Under his leadership, the company has launched Alphagrip's maiden Alpha Mine Absolute Return Fund Category 3 AIF. He has over 18 years of industry experience and is an MBA in finance from SP Jain Institute of Management. Mr. Bhautik, so privileged to have you here. The stage is all yours.
Thank you so much, Aishwarya. And thank you, everyone, for joining on this call today. And, a very big congratulations for PMS AIF World to have the sixth conclave. So what I'm going to do is, I think it's an extremely opportune time to be discussing risk-adjusted strategies or hedge fund strategies, considering the volatility in the markets that we're witnessing nowadays. I think it'll make a lot of sense for investors to kind of understand how some of these strategies aid or help portfolios in times like these, which generally, don't get protected, let's say, if they were just investing in traditional investments. I think the word risk-adjusted returns, to a certain extent, from a layman perspective, is difficult to understand. It basically means that for every unit of risk that you are taking, what kind of returns does one generate? I think from today's call, what we will try and understand is how some of the strategies that some of my colleagues here run as funds do help in better returns for the same amount of risk that you take, and how it is different compared to, let's say, what you generally do with traditional investments, so-called mutual funds or PMSs, which are not able to deliver similar risk-adjusted returns. I think another way to look at risk-adjusted returns is, let's say, you are driving a car and the journey for both the drives is the same, but one car is driving very recklessly and the other car is driving safely. The objective is not to just reach the end point or the end of the journey, but the objective is to enjoy the journey as well, which is what I believe is, what can be offered with better risk-adjusted returns or with some of the funds that some of my colleagues run here or even we run at Alphagrip. So with that, I'm going to start with the first question, which I'm going to be asking all the three panelists, and which is to very simply, what I can do is maybe Puneet, you can start on this. Is how do you, from your perspective, how does a layman kind of compare a hedge fund strategy or a long short strategy? Because some of these terms get used very interchangeably in the Indian markets. I know they are different from each other, but having said that, if one has to look at some of these products which use derivatives extensively as part of their investment strategy, how does one compare that to traditional investments, or how does one differentiate that compared to traditional investment? So, Puneet, maybe you want to start at this, please.
So, Bhautik, thank you so much for this. I think what you've spoken about is a strategy which is using derivatives in order to curtail the amount of risk that a portfolio is generating. So, I think Vineet also does something very similar in this field. Uh, by using derivatives, we can essentially hedge off the risk of whatever is the long position that you have taken in the underlying portfolio. So if you have a portfolio which is all long onto a certain specific sector, let's say banking sector, so you obviously have a index which is available in order to hedge off the position in case you are afraid of a particular fall in the market or any event which is going to happen in a field which may impact the returns from the equity portfolio that a particular investor may have or the management may have. The hedge funds that we have here in India are slightly different from what we would normally understand them to be. Obviously, there are a lot of restrictions on what Category 3 AIF can do or cannot do in India. Within those guardrails, I think we have a lot of opportunity to generate alpha using these strategies as well. That is something that we do at Whitespace Alpha as well. But having said this, in order to compare the difference between a long only strategy or a long short strategy or a hedge fund kind of a strategy, I think long only strategies are purely banking on the fact that in the long term, equity stocks or whatever portfolio of stocks that a particular investment manager has picked, they will generate a certain amount of return out of just pure capital appreciation. On a hedged portfolio, what additionally you can do is that by also accounting for the capital appreciation from the equity stocks, there is a possibility of either restricting loss in the event that the particular stock falls or generating a small amount of profit while the stock is actually going up. That's, in my opinion, how they work well. Anybody else on the panel
Thanks.
has any inputs, will be happy to hear that as well. Sorry,
Puneet,
Vineet.
let's start with you.
Thank you, Bhautik. For the layman, I would first want to add, just to explain to them, that we have close to 1,000 equity mutual funds in the country. We have close to more than 500 PMS, around 500 PMS, and we have alternate funds, maybe around 100 alternate funds in Cat 3. And you will find that, about these 2,000 funds in the country, all the funds are focused on long only, means passive investment, do a lot of good research, buy the stock and sit tight and wait for it to go up. So it's the most focus is on research and trying to create an alpha of 3 to 5% over what the market does. But a very interesting data that I would want to share with you is for the last 25 years, Nifty has done a CAGR of around 13-14%. And 15 of these years, it has created a positive return. And 10 of these years, that is 2 out of every 5 years, it has not created wealth. So, that is 40% of the time annually, if you measure, Nifty does not create returns. But all the 2,000 funds, primarily more than 99% of them are focused on simply buying and waiting for the stock to go up. But what about those 2 years, which come every 5 years on an average, where Nifty does not create returns? So this is where the long short fund has an edge, because in these 2 years, you can also try to create returns if your view is negative. So mutual fund managers, if their view is negative, they cannot take benefit of it. All they can do is reduce their cash positions. I mean, increase the cash positions reduce the portfolio. But in a long short fund, you have the ability to use derivatives, to use it any which ways you want. You can short the market, and also try to create an alpha even when the market is going down. And the second point I want to mention is that primarily all of us, in research are focused on trying to create an alpha of 3 to 5% over the year. But we fail to recognize that if we see, I mean, we have tracked the volatility of F&O stocks, 200, 180 to 225 F&O stocks for the last 4 years, 5 years, what they do on the difference between their highs and lows in a year. And if you hazard a wild guess, people might say that the price between the difference between high and low could be 20%, 30%. But the price differential between their highs and lows in each year is more than 80 to 120% a year, which is a crazy number. And if you compare it with an alpha of 3 to 5%, it is probably 10 times more important to track the volatility in the stock. Whereas long only the traditional investments, they are not worried about volatility. All they say is that, try to stay put, try to buy the right stocks and do the right selection. So this is long short is much more dynamic, and you need a lot of expertise in handling this. So, and this is probably how it is extremely important and different than the traditional investments. And it is for that period where, those 2 years where most of the other fund managers will be helpless. This fund at least has the possibility to generate an alpha even when the markets are going down.
Thanks, Vineet. Kalpesh, do you have a perspective on this?
Yeah, so very well said by Vineet. So what we have seen, at least in India, the long short actually came into place in 2013, and over the years we have been seeing a good amount of attraction by the HNI clients in the long short fund. But why they are seeing attraction is as is as you already said, the long only mutual funds are something which are giving you good hope for the next 5 to 10 years. But there have been many years where the markets have given negative returns. So in such case, long short funds are something which helps you in equalizing your expectation, and it also helps you in getting positive returns even though markets are down. So, and what we have seen in last few years is like Indian markets have evolved very heavily in on the futures, and as well as majorly on the options front, where the volumes have been at least, if not less than 1000x in last 10 years. So there has been very high liquidity in the options front, and options has been one of our core base to make money in our long short strategy. So overall, there have been some regulations within our Indian as compared to hedge funds, but overall that regulation is something which is good because it helps us to curtail our risk, because there have been situations where hedge fund gets bankrupt largely because of the over leverage they take. But in India, we have this restriction of 2x max coverage of your AUM. So I think what we have in our in India is basically good amount of risk management by the regulators, and what we can do within our framework is something which can help us investor at least on the volatile markets like this. Like when markets are down 14-15%, most of the long short funds are giving you 7 to 8% return. So this type of volatility will actually help to which will actually get reduced when you use a long short fund as your category.
Thanks, Kalpesh. So I think that helps me segue into the very relevant point, which is again extremely pertinent in times like these today, where the markets have corrected in the last maybe 4 to 6 months, and they corrected fairly sharply in certain segments of the market. Vineet, maybe I'll direct this question to you. Do you think that there is an opportunity for investors to capitalize on both rising and falling market scenarios using hedge funds, long short funds, or do you think these kind of funds only make sense when markets are falling? And in those kind of scenarios, can one take an advantage by participating in some of these long short funds?
So, Bhautik, I guess this is one of the toughest questions to answer. And the answer actually lies in, the view of the market. And, it's very easy to say that, tomorrow the market is going to go up or down. but we never try to predict market. And if somebody has a very clear view that the market is going up or going down, then definitely we can benefit, because it's an option you have. If you have a view, for example, if I am a equity mutual fund manager, and I've bought 20 stocks, a well diversified stock, portfolio, and all I can hope is that industry will do well and the stocks will go up. But just in case, what is happening for the last couple of quarters, we're seeing the quarterly numbers are very bad, and even the next quarter numbers do not seem to be auguring well. It does not seem that they will be good. So I have a negative view, but being an equity fund manager, I cannot do anything. I'm helpless. All I can do is have a little more cash. But in case one has a strong negative view, a view on the market that the market is going down, like we have currently, and in that scenario, definitely the fund manager of a long short strategy fund has an option to create more shorts than longs and try to hedge the portfolio. But it will be very, very difficult, and depending on what the objectives of the fund are, whether he's trying to preserve wealth or create wealth. And it's easier said than done. But even if I have a negative view, and let us say the market moves up, the fund manager may actually end up losing money, because it's purely based on the directional call you have taken. And if your directional call is wrong, you may not actually end up making money. But at least if your view is clear, you can reduce the risk. So I cannot say that the investor will be, or the fund manager will be able to create wealth on both sides, because having a market view is itself is very, very difficult, and having a clear view about the market is not so easy. But definitely, if the valuations are high and you are not liking the market, you can engage in de-risking your portfolio by creating more arbitrage positions, by creating higher shorts positions. And there is a possibility that the fund manager can actually try to create wealth. Yes, it is possible, but I will not say that it can be done easily. It's a very, very difficult thing to do, but can be done.
Sure. So I think what I'll do is, Puneet, maybe I'll jump to you as a next point here. And the point I want to make here, and the question I want to ask you here, is that I think this is something that you all offer as a solution, like even we do at Alphagrip, is to offer replacements or solutions to, for example, fixed income or equity, by combining fixed income with, let's say, derivatives trying to generate alpha, by combining equities with derivatives to again generate alpha.
Right.
Now, why do you think that is a good solution? B, why is it better than just investing in a pure play traditional debt or an equity product? How is it different? How is it better? And why is that solution kind of making sense for clients?
Sure. Well, before I even get into the details of why this is probably better solution compared to the other alternatives that are there in the market essentially are long funds, which are more passive in nature. Our funds, and I'm assuming something very similar happens at Alphagrip as well, is this is more of a replacement for funds which are more passive in nature, and thereby somebody who's already taking a view on the market is confident of the India's growth story, and that's how it's going to pan out, and that's how it's going to reflect in the Indian equity markets as well. It's a very good alternative, because what it allows you to do is, in the long term, equity markets are expected to go up. And Vineet obviously very articulate in emphasizing the fact that they've delivered about 12 to 15% kind of a return, 13%, I think, if I remember correctly, over the past 20 odd years. That's something that is expected to continue in the near future as well, and in the long term. So banking on that, but at the same time, if you're able to add an alpha on a month-on-month basis or a quarter-on-quarter basis to the investment of the portfolio, that just makes the whole story a lot sweeter. So while the equity market goes up by, let's say, about 12, 13% in a year, averaged out over a long period, of course, a market neutral strategy, which kind of makes money when the market is going up or when the market is going down, that primarily obviously using derivatives and solutions that you have built around options and futures. So that enhances the returns that an investor can generate out of this long portfolio comfortably. Also, it reduces the volatility in the returns overall, because when the market is going down, you lose less than the market. That's very critical. When the market starts going up, you're starting off at a base which is much higher and thereby gain a lot more when the market correct and go up again. Similarly, for the debt investment, if somebody is investing into a debt portfolio with a very secure kind of a return that they want to achieve out of that particular portfolio, a debt product with an essentially very low risk strategy on the derivative side can generate an alpha. It's possible, it's risky, but it's possible to generate those kind of alpha. And like you started off the entire discussion, risk weighted return is essentially what we are aiming to generate out of all the portfolio that we also manage. So there, it's a very good replacement for somebody investing into the debt portfolio, because while the debt portfolio currently will generate about, let's say, about 7 odd percent, this kind of a product can, and other similar products in the market can generate an additional income, an additional alpha over and above the 7% in order to generate long-term growth.
Sure, thanks, Puneet. I think Kalpesh, you also operate, a fund which is in a similar category, return category. Your take on that. Why do you think it's a good, solution or a replacement to fixed income?
Yeah, so there are a couple of reasons why we could see good attraction in the long short fund. So in fact, in India, majority of the long short fund do operate as an absolute return fund. There are a few who do something like over and above alpha, but overall majority of us are something which targets 12 to 15% on an annualized basis. So now when you see fixed income returns in India, they have been now around close to 5 to 5.25% post tax. So this is something which we referred, because now if you see earlier there was 3 years of taxation indexation benefit over there, but now there is no indexation benefit, and we could see lot of shift at least from the HNI front, if not from the corporate, from HNI front, which are taxed at now 40%, are looking at as an alternative to debt. And even if you see when it comes to long short fund, when you see the composition of a long short fund, 85 to 90%, or if not 90 but 85% of the money actually is parked into debt instruments, and what risk we take is from that 15% which we have. That risk could be in the derivatives front, that could be in the equity front, but this is how long short funds are something which are more or less operating. And why it has been attractive is, one is the tax advantage, or not the tax advantage, but the tax free returns to the investor are as are 7.5 compared to what we get in the debt fund, which is 5.2 to 5.5. Even arbitrage fund now post tax is giving you close to 5.25 or 5.5% return. So one is obviously this one type of tax post tax return is slightly higher. Second is, there are a lot of people who don't want to play a larger equity game at current levels, and even in the last couple of years we have been seeing markets going up and up and up. We are seeing now some bit of cautiousness across HNI as well as treasury. So that type of investment are also now chasing. So if you go and listen to large long only mutual fund and as well as PMS guys, they have been articulating returns of close to 10 to 11% on a 3 to 5 year perspective. So if that is getting at 11 to 12 or 10 to 11% in a 5 year perspective, I think that long short fund is something giving you similar returns and with a very minimal risk on the downside. So such type of arguments are something which is helping long short fund to gain good momentum.
No, I think that's very relevant. I'll just add to that part is that we've seen a lot of interest amongst investors for such conservative absolute return funds, which can offer a better solution compared to, let's say, a fixed income solution by offering an alpha of 300 basis points. Again, something that we also operate in. Similarly, we have funds which operate in the more maybe higher risk category, which can offer again an alpha compared to maybe a large cap fund or an ETF by effectively using derivative strategies, by not only generating alpha, but also trying to minimize risk. So these are solutions that we've seen being effectively implemented in the long short space, or in a space where people are using derivatives in Cat 3. I think what I'll do is I'll move to the next point, and Vineet.
I want to add 2 points.
Yeah, please.
Yeah.
Please go ahead.
So most of you guys are, also doing the debt plus or similar products to debt by having more of, I will not say market neutral, but something similar to market neutral strategies where you don't end up losing money like equity does. So what we are doing is, what I will also encourage you to consider is that equity mutual fund market is more than 20 lakh crores. And the AIF, I mean, we guys are sitting here, but we know there's hardly any, even 1% of the AUM is in long short uh,
1 lakh
category.
is what I
Yeah.
could say.
Yeah. So, what I mean to say is that the kind of strategy we are doing a covered call strategy because it is very, very similar to an equity mutual fund. For example, it's an equity mutual fund, but you use derivatives. You have a very diversified portfolio. The only difference is that portfolio is more into the 225 stocks that fall into the future and option segment. And you use derivatives for three reasons. One, you want to hedge the portfolio. You feel that, okay, the market is seeming risky, I will hedge the portfolio. The second is, you and the hedging could be by buying put options or by selling futures of index. The second is you hedge the portfolio by putting it into an arbitrage position. I have the cash stock, but I think some policy is going to come out, or Mr. Modi is going to visit US. Why not, not be out of the market for 2 days? You sell the futures, you create an arbitrage, and you be out of the market for some time. The third and the most powerful tool which we are using is the covered call. So covered call essentially makes us very similar to an equity mutual fund, but every month we are trying to generate some alpha by selling call options on the underlying portfolio. So if you guys consider, or if we have more funds coming wherein you want to sell covered call options, then the fund is more dynamic because then it has the option to create money in all kinds of scenarios. When the market is going up, you create money. When the market is going slow, you create more money. When the market is stagnant, you have the best outperformance because you might deliver 10 to 15% returns on a stagnant market in equity, and which is a great number. And the point you also mentioned earlier was why this has an edge is the example you gave about the kind of journey you have. So because we have the option, or these funds have the options to use derivatives, the volatility in the portfolios are much lower, and which results in delivering a much higher, sharp ratio or a very higher risk adjusted return. Because, for example, we have 945 mutual funds. So we have not done too well last year, delivering hardly 8 or 9, 10% returns in the last calendar year. But if you see the Sharp ratio, we will rank number 3 in the country. Only two more funds have a higher Sharp than us. So for those people who are conservative investors, even in the equity domain, if they get the option to put small monies into these kind of covered call funds, or derivative uh, funds which use derivatives to reduce the risk, I think it will be a great option for a common man. But today it is only the rich guy with a minimum net worth, or 1 crore investment that goes into it. If SEBI understands that, or we guys can make presentations to the industry, and even the small investor demands that, okay, it's a low risk strategy with similar funds to equity mutual funds. Why should I not be allowed to invest in such a fund? So if SEBI opens it for mutual funds industries to use these kind of strategies, I think it will be more tax friendly, and a smaller investor who does not have a large corpus will also be able to benefit from these strategies, which are great, where a risk adjusted return is considered. So my plea is only that somehow Bhautik, you are also part of other organizations, so I'm sure you can we need to think and let the
It's a
authorities
very
know.
relevant point. Yes, yes, yes. It's an extremely relevant point. We'll try and take that forward, with using our associations that we are members of. Uh, Having said that, and what I will do is, Puneet, maybe bring you in here, that when investors, let's say when they're investing traditional products, let's say a PMS or a mutual fund, it's very easy for them to kind of understand whether the strategy is effective or not by comparing the performance of that fund with a relative benchmark. And you can very easily compare and understand whether the fund was, did outperform, underperform, how effective was the fund or not. Now, how does one do that for a long short strategy? right? Because let's say some strategies don't even have benchmarks. Even if some strategies have a benchmark, then how do you kind of compare, considering the fact that you're doing a combination of equities and derivatives? And there is this additional complication of fees, which is slightly more differentiated compared to what you see in traditional PMSs or mutual funds, and an additional element of tax.
Right. So you brought up tax right at the end, but I think that is one of the biggest differentiator between what we do versus what a PMS or a mutual fund would do. Obviously, as a Cat 3 AIF, you're taxed at the fund level and therefore no pass-through taxation. Even in the new draft of the Income Tax Act, the Income Tax Bill of 2025, there's status quo, no changes there. I am sure that you guys would have already seen that as well. But addressing the other points, yes, benchmarks is something which is kind of a gray area as of now, but I think there are steps being made to kind of regularize it, or reporting has to be a lot more uniform, which is in the works from whatever that I understood. I don't know how effective that is, or how it is being implemented. But having said that, I think all of the funds, they really have a target in mind, or a benchmark, which is at least, if not put down on paper, they at least are aiming to generate a return, certain benchmark returns that they're able to generate. Best is to compare it against what a particular fund's benchmark is. For instance, if my equity fund has a benchmark of Nifty 50, I intend to beat Nifty 50 on a periodic basis. For me, the target is on a month-on-month basis. Other funds will have different objectives. Maybe Vineet's fund is also looking to do something similar on a month-on-month basis, generate an alpha over and above their investment into the portfolio of stocks that they have. A very critical aspect in this one is the amount of exposure being taken in a particular sector or in a particular category of market capitalization. So for a lot of the funds, they talk about uh, investing into small caps and mid caps, but they invest into BSE 500 stocks or NSE 500 stocks. Still, a majority of the exposure lies in the large cap stocks. So those are differences in the benchmark, which is something that the investor needs to be aware of. Unfortunately, I'm not the authority on this one. I can speak about my funds. We are very clear about the benchmarks that we use. We are Nifty 50 and the interest rates which are prevalent in the market right now, represented by T-bills or FD rates. So as long as a particular fund is beating its own benchmark on a month-on-month basis, over a period of time, for sure it is going to compound and deliver a phenomenal return. So that's something that the investors should clearly be looking at. Speak to the fund manager, get a clarity on what the benchmarks is. That's probably the first step that I would recommend anybody evaluating similar products. Anything that if I missed out, let me know. Bhautik.
No, I think what you said just makes a lot of sense, that people might have a perception that it's difficult to compare or judge the performance of some of these long short funds. But I think all long short funds do offer a benchmark. It could be a relative benchmark, it could be an absolute benchmark, but there is a benchmark which I believe is available with most of us, and which means that for investors to judge the performance, I think it's as easy as that they would be able to do with a traditional product. So I think it's more about a perception rather than an actual framework out there. I think considering time out here, I'm going to pose the last question to everyone out here, which is looking forward, right? And we've seen a bunch of products in the market today. So we've seen conservative long short funds, we've seen aggressive ones, we've seen some in the middle. We've seen funds which are being managed, using discretionary fund managers. We've seen funds being managed using a quant strategy. We've seen funds using multi-strat. So there are funds which only deploy equities. There are funds which use a combination of multiple asset classes. So we've seen a bunch of different products out there in the market already so far in the market. I think what I want to ask you all is, going forward, maybe in the next 3 years, 5 years, where do you think this industry is going? Do you think there'll be more people who will be gravitating towards these long short funds? Do you think there'll be more innovations which will happen in long short funds? Where do you see this going? Maybe Vineet, you want to start and then we can go around.
I'm already smiling at the question, So when equity is doing well, like 3 out of 5 years, it does very well. So nobody needs to look at an alternate thing. You simply put money in mutual funds and ride. But when the difficult period starts, for example, now this calendar year has been pretty challenging, and we've seen Nifty correcting, and now possibly, a big sell-off might start from. I mean, you cannot predict the market, but the way technical charts are showing, we may have a bigger sell-off coming. So people will need those options where at least the fund manager has the flexibility to generate some returns. Because mutual funds, you see all the fund managers, all they talk about is equity mutual fund managers is outperformance care. What do you mean by outperformance? I mean, you're willing to say कि हम 10 निफ्टी 10 गिरेगी, हम 8 गिरेंगे, 12 गिरेंगे. What do you mean? You're still talking about negative returns. So, based on the small survey we had been doing with our investors, 80% of the investing community says we need performance, we need returns. But all the people evaluating these funds, the distribution channel, what do they want? They say कि हमें तो भैया outperformance चाहिए. अब outperformance में आप -10 गिरे हो, -20 गिरे हो, does not sound very interesting. So I think with the more volatility and the global risk we have, with USA doing a lot of things differently and global demand slowing down, it is going to be a golden era when these alternate products are going to be, considered by even those people who think it as risky. I would just want to add that using derivatives in the wrong way increases the risk, but using derivatives to hedge the portfolio actually reduces the risk. So these long short strategies and derivatives, where derivatives are used to reduce the risk in the portfolio, can actually deliver a much better risk adjusted returns or sharp. So going ahead, because the market is expected to be more volatile, I think in the next 1 to 5 years, the industry has a great chance of doing well. Again, I would want to reiterate that a smaller investor today cannot be part of this pie, and something must be done that even smaller investors can adopt these long short strategies.
Okay, sure.
Yeah. So I think one data point which I would just want to say is it's very difficult to earn your first 1 crore of your life. So even in and then it's very easy to make it a fourfold, fivefold. Even in AIF, what we have done in last whatever 10 years is an AUM of close to now 1 lakh crore, which it took 10 years to build 1 lakh crore of AUM in CAT 3 AIF. My sense in the next 3 to 5 years, it should be a 10 lakh plus crore journey for us. And what we are now sensing is like if you see, it's a scenario where interest rates are going down, so there are a lot of less alternatives for HNIs, for treasury clients to go and buy into fixed income products. So this is something which will help us in gaining a good momentum. However, there is always a tax advantage as compared to an AIFs and mutual fund. But I think in everywhere in world, the advantage of tax will not remain forever, and there could be some sanity at some time. But overall, my sense is, even if you do a post-tax return, also long short funds are giving you a much smarter return as compared to a normal fixed income product like corporate bonds or as well as an arbitrage fund. And I think with this call writing scenario which Vineet has mentioned, I think this has been a true if you see, I come from a HNI background, so I know people have been itching to sell calls across their portfolio. I think the one which got restricted because the SEBI has came with a 50% rule of cash in their while doing a call writing or any of the derivatives position. But as a fund, we are not or required. We can just park in our GSEC and do that. So I think if you give the money to the fund, call writing can be done in a much better way as compared to you doing it on your own because of the margining issues. And overall, my sense is with this volatility, and I think this volatility will till should remain in markets for the next 18 to 24 months, given that a lot of political changes have happened. And overall, historically, whenever Trump is there, there will be volatility in the market. So I think more or less it's a good scenario for AIF to the next 3 to 5 years.
Right, so I'll just quickly add a couple of points to Kalpesh. Very well said. I think a lot of volatility expected. probably some adversity as well, but adversity is what leads to innovation. I think there's a lot of scope of innovation in the field that we are in. There is definitely a bit of a overhang from SEBI and a couple of other places. But given that, I think I would expect a lot of newer kind of funds to come out and bring out more strategies into the overall play in order to hedge the portfolios, generate additional returns, or generate absolute returns. So yeah, I'd be keenly looking at the space as well, because I think there is still a lot of scope for development of this particular field. If regulations improve, if we are able to do more with what we already have, then I think that is one more impetus that we would definitely have in the industry for innovation to kickstart.
Thanks, Puneet. Thank you, everyone. I'm just going to leave everyone with one final thing from my end. And considering we're a cricket-loving country, in investing, it's just not about how many runs you score, which is nothing but the returns, but it's also very important how safely and consistently you score them, which means what kind of risk are you taking to generate those returns or score those numbers. So please do focus on that as well, which is what all of my colleagues spoke about. So thank you so much for having us here.